So, when you are thinking of setting up a business or when you've set up a business, one of the resources that you're really going to need is finance. So what do we need to know for this part of the specification? You need to be able to understand different sources of finance and identify ones that are suitable for certain types of businesses. And you need to know the advantages and disadvantages of those sources of finance. You need to know which ones are internal, which ones are external, which ones are short-term, medium, or long-term sources of finance. So the easiest thing to do is to imagine that you're setting up your own business, and you think about, how much it's going to cost you and where you think that finance would come from. And there's many different areas that businesses can source money from, or they can time their costs to try and minimize all of them coming out at the same time. So these are all the different sources of finance. Well, actually, there's a few more than these, but these are the ones that are mentioned on the Welsh Board specification. And having a good overview of them all is great. But I'm just going to go through a few of them to explain the advantages and disadvantages, because this is the most kind of common question that you would get. So in terms of a loan, I'm sure you all know what a loan is. You go to a bank, you ask to borrow a certain amount of money, and then so they say give you the £10,000 and you spread the repayments over a period of time. So you might get £10,000 and you have to pay it back over 2 years. So they would divide 10,000 by 24, so it's more manageable for you to repay it. But so you get the big inflow of cash at the beginning, but it's manageable chunks to repay it. However, you do have to repay it, and also you have to pay interest on top of that, because that's how banks make their money. They're a business as well, so they're not a charity. So that's a pro and a con of a loan. If you're comparing that to an overdraft is a little bit more flexible. So for example, you only take out an overdraft for the amount you actually need. So when you're taking out a loan, it's more of a formal agreement, and you have to go to a bank and you sort of have to estimate how much you need. So say if you took out a loan for £10,000, but actually in the end you only actually used £9,000 of it, you still have to pay the interest, and you have to make the repayment on the £10,000, unless you've got some kind of agreement where you can do a kind of early repayment. But it's a more formal contract, whereas an overdraft, you just take it out for the amount that you need. So I'm sure you'll get used to the concept of an overdraft when you go away to university, but you just charge the amount that the costs that you incur onto your account or onto your debit card, and you only go into the overdraft the exact amount that you need, but the interest payable on an overdraft is usually a lot higher than on a loan. And also it's not such a formal agreement as well, so the bank can actually ask for you to repay your overdraft back whenever they want. So it's a little bit more risky. Okay, you could introduce money into your business by selling shares, so you're selling a portion of your business, and that money doesn't have to be paid back. But the problem with that is, in return for acquiring this money, you're giving away a little part of your business, and it depends how much you're selling in the form of shares, but you might be giving quite a lot of control to other people, a person or quite a few people, depending on how many shares you sell. And once you've sold them, unless you were to buy them back, which would be very expensive for you, they're sold, they're gone. So it's a very long-term decision. Debt factoring is one you've probably not heard of. So debt is money, or debtors are people that owe money to a business, and so they're usually your customers who haven't paid yet. They've taken ownership of the items that you've sold them, but they just haven't paid yet. And sometimes you get debtors that are a little bit bad, and they take ages to pay, and you've called them up and called them up and called them up, and they've just not they've not sent you the money yet. So what you can do is you can sell on this debt to another business that deal in debt collection, so they're specialists in this, and so it, you get this inflow of money from quite hard to chase customers. So at least you get some of that money back. But depending on how the debt collection company works, you either have to pay a fee for them recovering the debt, or you get less than the full amount owed. So you might get 90% of however much that debt is. But on the bright side, you're getting money in that you might not have recovered yourself. So it's not a bad form of finance, but obviously it wouldn't be appropriate for a startup company because you wouldn't have any customers yet who owe you money. Government grant, fantastic form of finance because it doesn't need to be repaid. It's money just given to you to help you set up your business usually. But there aren't many available in the news. There's a lot of stuff, especially at the moment with the election coming up, about the government's trying to balance the books. So for the last few years, the government and previous government as well, before the coalition, spent more than they earned in tax revenue. So they've tried to cut any spending that's not seen as essential. So a lot of government grants for startup businesses have disappeared. And you also have to qualify as well. You have to meet certain criteria, and they're usually quite hard to meet as well. Hire purchase. So this is when you purchase a product, usually machinery or a vehicle, but rather than paying outright for it, you pay in installments. So you get the use of the machinery immediately, but it is more expensive over the long run than just paying for something upfront. Sale and lease back is, say if you have an asset like a machine, or you have a vehicle, or even a building that's worth quite a lot, what you can do is sell it to a special business that deal in kind of sale and lease back deals, and so you get a large inflow of cash, and then you rent it back from the business that bought it from you, so you still get use of that piece of machinery. But the negative of this is you can only sell the asset off once, and it's sometimes thought of, there's a term called selling off the family silver, so something that's kind of valuable to you, and over the long run it's more expensive to lease it back, in terms of the money that you receive from selling the asset. If you keep on leasing forever, the money that you receive from selling it is going to be far less than the money that you spend on leasing the product. So that's just a quick overview. It's not all of the sources of finance that we saw here, but it's quite a few of them. But I'm sure that you can look up the other ones, friends and family. I'm sure you can think of the benefits and the disadvantages of that yourself. Trade credit, that's just when you are getting your supplies and you get 30 or 60 days to pay. So you could get an extension on your trade credit by maybe 30 days or something, and it just helps your cash flow situation. You still owe the money, but it just means that you've got a little bit longer to pay it. So in terms of internal versus external, I've not put them all in here, but internal sources of finance come from within the business. So retained profit, money that's been reinvested in the business that you made last year, reinvest it into. You could sell your fixed assets, anything maybe that you don't need anymore. So you might have a building that you don't use anymore, or machinery, or a vehicle you don't use anymore, or any debts, any debtors, money that's owed to you, you could try and collect that. So that would be an internal source of finance that you could generate. And external sources of finance, they just involve other businesses or other individuals, and they come from outside of the business. So going to the bank for a loan or an overdraft, or selling shares involves outside investors, or hire purchase involves another business. Trade credits or grants, again, external sources of finance. I've not put them all in here, short to long term sources of finance, but an overdraft is a more short term thing. Debt factoring, I've put it as short term as well, because It's just sorting out a certain problem that you have with collecting these debts. Probably if you're doing debt factoring, your accounts department's not doing a brilliant job chasing up those debts. So you probably want to sort them out as well. You don't want to be selling all your debts onto other companies all of the time. Medium term would be a loan or, say, sale and leaseback. Sale and leaseback's a bit of a funny one. It could go into long term, but I've put those as more medium term sources of finance. Whereas long term, if you sell shares, you know, you've sold a part of your company forever, really. It'd be quite complicated to get it back. Okay, this is really interesting to look at. Again, I've not put them all in, but I've just put some ones that are quite relevant to these types of businesses. So if you're a startup, it's quite reasonable that you'd go to friends and family, really. The problem comes where you've got a business that's a PLC and students are saying, oh, they'd go to friends and family. No, they wouldn't. It's only really, you know, kind of startup businesses or maybe sole traders that go to friends and family to borrow money. And, you know, it might be great because they might give you, they might charge you no interest or a very low rate of interest. But things can get quite complicated with family matters. They will say, what's that phrase? Don't mix business and, don't mix family and money. And maybe like the family would want to have some form of decision-making power, which may or may not be a good thing. Government grants, usually, a startup business, you're most likely to be able to qualify for a government grant, or a sole trader, a government grant would be relevant for. A partnership, you don't have shares in your business, but you could introduce a new partner and they could kind of buy into the partnership by introducing some money. An LTD and a PLC, of course, those are public limited companies, PLC, and a private limited company, so they can sell shares, but the others can't. So just make sure you know that not every source of finance is relevant for every different legal structure. Okay, so we've got lots and lots of different sources of finance. The last slide identifies sources of finance that are only really relevant to certain types of legal structure, and explaining the advantages and the disadvantages is also very important for this type of question.